Fed, go, then wait? Is that the ideal?
That is
scenario
ideal.
Now?
Yep, that's ideal, and it's also the most likely. I agree with Marianne. And unfortunately, Joe, I think that is what we're going to see. But, Judge, what I'll point out is something that I pointed out to you yesterday on the NYSE. We have seen a building in risk appetite pretty substantially. It's not just Apple. It's a whole host of things, including the broad market.
But wait, because you told me not that many days ago that you had big put buying in the S&P.
On Monday, that was a one-day expiration, and I explained it at that time. Those were puts that expired that day. They bought them at 30 cents.
This has turned into a trader's market with the shortness of what we're seeing in the derivatives world.
Been able to change that much, that dramatically, that in a short period of time?
Yes, this same thing, Judge, the IWM on Monday hit 141.50, thereabouts, the IWM Russell 2000. I told you yesterday, strong buying throughout the day, especially into the end of day. Did somebody get an idea that maybe there would be bail set and that the CFO would indeed get to walk out of jail? Maybe not out of Canada, but out of jail. And that the president would say that I'm going to fight, if this can be something that I can negotiate with.
Trade negotiations.
Yep. So that is up 2% from yesterday afternoon. That's the IWM. NVIDIA today, we heard that SoftBank may be selling some of their stake in NVIDIA. The stock traded down through 145. Bang! Comes right back up through 151. That's showing you that there's a risk appetite. It's not just we're seeing a little bit. We're seeing bigger stocks that people are willing to take bigger bites out of, including
Apple being the best example of them all. I mean, the other day, I know that Josh was talking about Bitmojis or whatever the heck he was talking about charts. But the 20,000 calls they bought that were short-term, Scott, that said a lot about what people were thinking about Apple. And that literally was a turnoff of 164 towards this 170 level. So you're seeing a lot of really, really short-term paper in the derivatives market. Not people just talking about it, people putting real money on trades and betting on short-term events happening. And they're actually being more and more correct each and every day.
Look, Josh may turn out to be correct in calling Apple at that bottom level that he said, based on technical trends that seem to be changing. And right now, the evidence suggests that maybe he is. We need a larger sample size, obviously, over a greater period of time to see. Marianne, you think we bottomed from the most recent pullback that we saw? You're pretty optimistic about next year, so you don't see this whole thing falling apart.
Well, we actually see it falling apart next year. So we think that there's a good chance that the markets are really oversold. We have some really good indicators that there's a good enough washout, which is why you're seeing the risk appetite. We think we get a rally, but we're concerned next year that it does fall apart. And we think we are going to see bear market returns. We think March is going to be a big risk catalyst with the debt ceiling. We've got gridlock in Washington. Could be kind of a repeat of 2011.
But you're looking for 2,900 on the S&P.
At the end of next year. But we think we go down first before we rally into the end of next year.
So it gets reverse of this.
It gets worse before it gets better.
So we have a short-lived bear market.
Correct.
Is that a growth scare? Is that an earnings scare?
It could be a debt ceiling scare. March of 2011, our debt was even downgraded. We almost shut down the government. So that could be part of the catalyst that keeps the market rattling. We'll have to look at earnings. We still think that earnings are coming down. And when you look at earnings estimate revisions, more analysts are now downgrading their numbers than upgrading it. Great leading indicator in the direction of profits.
Hey, Steve, Gundlach on his webcast says stocks are breaking down, bonds are overvalued, and the Fed is on a suicide mission. The suicide mission being raising rates while the government deficit increases as a share of GDP. You want to weigh in on that? Because it plays into everything that we've discussed.
Well, I mean, the Fed should ostensibly be raising or lowering rates independent of the deficit. If there's an issue there, it's for the fiscal authority to deal with. That's just the ideas around monetary policy. I think the way the Fed finesses that is by giving the fiscal authority lots of time and notice about what's going to happen, which, by the way, the Federal Reserve did, and the current administration decided to run up the deficit anyway. But I do want to talk about what was discussed earlier. Don't get all that happy about the idea that the Fed is going to raise rates in December and then pause, because with that pause, by the way, is almost certainly going to come some tick down in the Federal Reserve's outlook for GDP.
They've already taken it, right? They were already expecting lower, and they dialed that back, right?
Now, some on our air said the Fed did not see a slowdown coming. Well, I have to say that the Fed did indeed see that coming, and they've been forecasting that slowdown for 10 months. When the market got wind of that, I don't know, but it's been in print for quite a while. No, but my point, Scott, is that they're probably going to take that 2.5% 2019 GDP forecast down some more. So I don't know. Maybe Pete or John or somebody wants to tell me how they would trade that when the Fed comes out and says, you know what, that 2.5% slowdown from 3 is really 2.3 or 2.2 or maybe even closer to trend. So that's going to be something for the market to digest.
You know who doesn't believe that is Kevin Hassett, right? Chairs the Council of Economic Advisors.
He does not.
Doesn't want to hear it. Talk to the hand on the fact that the economy is slowing down. He must have mentioned 10 times with you in your in the prior hour in the interview this capital spending boom, which your data suggests is not happening. I don't know what data that he and Kudlow and the president who talks about a rocket ship with Reuters are looking at.
And by the way, we don't talk about it a lot when we talk about what's happening in terms of the market. But one of the things I think that sort of undermined and caused the market concern for the outlook for next year was the capital spending decline. And we've had 3 months of really sort of negative to flat new orders for capital goods. And that sort of raised questions about the efficacy of the tax cuts. And I think that's part of what's built into the market next year is they were kind of on board with the Trump forecast of 3%, and now they're less on board. And we have not had this capital spending boom that was supposed to happen, or we had it for a little bit, and then it kind of trailed off. And look, if it comes back, I think maybe some market optimism comes back that the capital spend, that the tax cuts are going to work as advertised. But right now, there's a lot of skepticism, and it has to do exactly with what you bring up, Scott.
This is not us saying. I mean, Barron's calling it this past weekend, the corporate tax cut, a bust in their words for, not leading to a huge amount of M&A, not leading to a huge amount of cash being deployed. You saw Lowe's today talk about a buyback. They increased their buyback by a dramatic amount.
Well, to Marianne's point, you're seeing earnings estimates being taken down. Why? Because CFOs are telling the analysts the estimates are going to be lower, and the analysts are taking it down. That's how earning estimate revisions actually work. But Steve, in talking about the economy, isn't the message to the Federal Reserve, look, ISM, when you look at manufacturing, non-manufacturing, both in the upper 50s, labor conditions look good, but yet it's the interest rate sensitive part of the economy that is rolling over. Isn't that a powerful enough message to the Federal Reserve? There are parts of the economy that are strong.
No, because Joe, if you think about it, I don't know how to say it, but you got a hammer and you got a nail. And the only way to drive the nail down is by hitting it with the hammer. If the Fed has one tool, and it's interest rates. And the parts of the economy, they're going to feel it first, are always going to be the interest rate sensitive sectors. The idea that housing has come off and autos have come off is not telling the Fed anything it should not have expected. I know that's a couple double negatives in there, but in any event, that's exactly the way it's supposed to work. The Fed does not have additional tools to go target some of the other sectors that are out there. I don't know, it can't target biotech, as far as I can tell.
Right. Marianne, why are you so sure that you get into these bear market returns and then it reverses itself into another powerful rally?
Because we're in a longer-term secular bull market, really being driven by the digital era. It's really being driven by a lot of the technological advances that we're seeing across all of the different sectors. So we think it happens really, really quickly. But for clients that can't withstand this kind of episodic volatility, we're willing to raise a little bit of cash, sell a little bit of equities, and move to cash to ride out the volatility. But we're going to look to redeploy it right back in the markets next year. But our target of 2,900 is actually out of consensus. Most of the targets for the end of 2019 are much higher than ours. So we're looking for
there's still some over 3.
Yes. So we're looking for much more subdued returns, but we are looking for a longer term uptrend.
Yeah, I just wanted to say that it felt to me on Monday that there was a media apocalypse, as if every media was clamoring to say that this is the end.
Didn't watch our show.
Got New York Times, Wall Street Journal front page. Now it's a recession. You should have seen it coming. This is really the end. And I get it. It sells news, but the truth is we've come down 10%.
What's the reality then, Carrie? You tell me.
We came down 10%.
What's the reality then?
A lot of stocks down 20% or 30%.
Oh, yeah.
Autos and building are not that big as sectors in the S&P and not that important to the economy. So I can make a case that at 15 times earnings, even if there's only 5% growth, we're not that expensive on many names in the S&P, many names in the broader market.
So then,
and
you must be buying hand over fist then.
Well, I said last week we were buying Apple. I said 2 weeks ago we were buying Amazon. We have been buying stock here, but we're more aggressive in what we feel about earnings than the 0 to 4% that we think earnings can grow 6 to 8%, which is decent considering the alternatives are who wants to put their money in 2.9% 10-years, really?
We had Mark Lasry on yesterday, who sort of joined a chorus of folks who talk about volatility. And if you think volatility is going away anytime soon, you're missing something. Here's Lasry. We'll talk on the other side.
I think you're going to constantly have this volatility, and you're going to have more because as you have more and more investigations, you need to for him to get out of this, it's going to be sort of making noise. And that's what I think the markets can't deal with. So I think you're just going to have a lot of volatility.
Him is the president. That's who Lasry was talking about. Dems taking the House. Buckle up for hearing after hearing after hearing. Pete on the Hill, John too.
Yep.
And what that's going to mean for volatility in and of itself.
Yeah, and we've talked about this. When it dropped to 16 the other day, it actually was far too low. I even think right now at these present levels, I'd call it 21. At 21, volatility is probably too low for what kind of conditions we're in right now, Scott. I mean, let's go back to Monday, 500-plus point move. Tuesday, 500-plus. Now, I'm talking about from the peaks to the bottom, and the movement in between is even much more violent. The intraday movement, yesterday is a great example of that, where we were down and up and everywhere in between, finally finished off a little bit. So I think what we're looking at right now is volatility that's inexpensive. I mentioned last night to Brian Sullivan, I said, hey, look, I think you protect your portfolios even here because it isn't like everything is completely fine with China. It's not like everything is completely settled with the Mueller investigation and all the rest of this stuff. That's all still out there. And until some of that clears the way, I think volatility, I think Mark Lasry is right. It's here to stay.
Yeah, and not just the president. I know that's not the only thing Mark was citing just in that clip. That's the only thing he cited. But, beyond the investigations and the president, all those things Pete talked about, as well as corporate debt, as well as China, and exactly how does that play out, Scott, which is likely to play out throughout 2019 and probably into 2020. I'd love it if it could clear the deck in 2019, and if it did, we've talked many times, that would be a huge rally. But instead, with every day, every month that pushes out there, that's another string along of that volatility that holds it. We're now, I think, 47 days above 15 for the VIX. That's almost a record in this recent history.
Steve, you want in?
Yeah, I just want to say I'm listening to the conversation around the table as I have the past week and even the past month. And I think the big problem is you just cannot make an unalloyed bull story out there, right? Mm-hmm. Every story where you try to say, hey, here's why it's going to be great, has a big asterisk next to it. You do expect, we had at the table there somebody predicting earnings down in the 5% range. We see the economy coming off with the debate about how much, but nobody is there pounding the table saying, hey, you got this wrong. It's 3% growth, it's 3.5% growth, and it's a 3,100 S&P. And until that story changes, I think that's where you're going to have all this volatility, Carrie, in the market.
You didn't go as specific as what he said, but you're about as bullish that I've heard from most people w'ho've been with us recently.
It doesn't have to be 3%, Steve. We don't have to have. I mean, this year we had the 3%, but the economy can grow at 1.5 to 2.5, somewhere in there, and earnings for many sectors.
But where's the market priced? Where was the market priced, and how much of
the market is now priced at 15 times? The market's now priced at 15. It was at 18. Now it's down to 15. In January, it was at 18.5 times earnings. So we think that if you are selective, I'm not saying throw everything into the high multiple stocks because that's what's going to drive the market.
Market's not prepared for 2% GDP growth or 1.5.
I think the market has come off of the 3. I think the market no longer.
You want to go? I mean, 1.5. I mean,
2.5.
come on. If it goes 1.5 to 2%. You think the market's going to deal with that okay?
Yeah, okay, so 2.5, but
2.5.
not
No,
three.
but
We've stopped thinking
that's
about
the potential growth, Scott. That's the
2.5.
number that is the number that most economists say you add up productivity and labor force growth, and that's the potential. With the question as to whether or not Kevin Hassett is right, and I still hold out some hope and some possibility that he is, that you are able to change the DNA of the economy, raise that potential growth, and then justify those higher PE multiples that the market was at several months ago.
That's right.
So 2.9 goes to 2.5 possibly from 18 to 19. I think the other part of this, we were talking about volatility. 1% moves for the S&P. The median since 2010 is 50 instances in a year. In 2017, you had 8. That's such an anomaly. So far in 2018, you've had 59. And I keep talking on the show about the absence of liquidity, and people are saying, well, exactly what do you mean by that? And Steve can appreciate this. If you're in an environment for the better part of 7 years where the Federal Reserve is continuing to buy treasuries and allowing speculators to go out, sell the treasuries to them in perpetuity, basically, and redeploy that capital. Now you remove that from the marketplace and you take away some of the buyback enthusiasm on the part of corporations. You're going to have an absence of liquidity, and you're going to have markets that are going to go highly volatile.
The other thing I want to get into before we take a break, Steve, I'm going to say goodbye to you now, and thank you so much for being a part of the conversation. I know you'll be back with us soon. Steve Leisman down at the New York Stock Exchange. I want to hit this. If we're talking about where the market can go from here and what you may buy to get it there, you get another downgrade of the banks today. Which is interesting just because the ownership levels on this desk of some of the names within that universe. It's Keefe Bruyette Woods today downgrading a number of things down to neutral.
Might be a sign of the bottom.
Yeah.
Maybe.
Yeah.
I mean, okay, I raised
late.
the question. We were discussing this, back with our show unit of, okay, you're telling us now, you're downgrading them to neutral. These guys haven't really done anything. Atlantic Equities, though, has also taken some names down. They take the target of Morgan Stanley. They downgrade Goldman Sachs. My point being is just add more people to the thought that the bank stocks can't do anything.
Yeah, and I think that might be finally the throwing in the towel and the opportunity for people to start looking at these banks. Because if I was doing the exercise yesterday of looking at what is the most beaten down areas in the market right now, and you look at, okay, what are the low PEs? What's really been sold off? It's energy and it's financials. You look at some of those names, and a lot of them look like they could be screaming buys. Have not performed. 100% granted. This year they have not performed. Maybe that's the names that next year people are going to be looking at much more closely, Scott, as they look at these volatile markets that we're sitting in right now. I added a bank stock today. It's going to be an unusual activity, so we'll be talking about that one. But I got to tell you, we are seeing paper flows start to come into some of the banks, which we hadn't seen. So maybe this is the area where we start to see some bottoming, especially given where they are in terms of the sell-off.
Dip buyers have been burned so often
absolutely.
in this correction. We'll see if it holds. I'll give you the last word. Marianne Bartels, thank you so much for being here with us today.
Well, thank you very much. And for our clients, really what we're trying to say is we're still in a longer-term secular bull market. Buckle up. It's going to be a rough ride for the next 6 months, but we're looking for a great buying opportunity.